For over 150 years, America's wealthiest families have been hiding their money in plain sight. Not in banks, not on Wall Street, but in a place almost nobody talks about. Why? Because while banks themselves quietly use it to strengthen their balance sheets, they'd rather market you products that make them more money. And because it's steady, boring, and doesn't make flashy headlines, most people never learn how powerful it really is. Yet, it's the one place that has quietly survived every financial crisis in US history. I'm talking about mutual life insurance companies. And before you click away thinking this is some boring insurance pitch, let me share a number that will change how you think about financial safety forever. Over US history, tens of thousands of banks have failed during cycles of stress and regulation shifts. During the Great Depression alone, 9,000 banks collapsed in just 4 years. During the 2008 crisis, 489 banks failed in a single 5-year period. But here's the number that should shock you. In that same 200-year period, the number of major mutual life insurers that failed, they have been so rare you could count the major ones on one hand over 2 centuries. Let me put this in perspective. You're more likely to get struck by lightning twice than to lose money with a mutual life insurance company. Yet every financial advisor tells you to keep your safe money in banks, institutions that have literally failed by the thousands. And just so we're clear on the word mutual, it means the company is owned by its policyholders. There are no outside stockholders. The company exists to serve and benefit the people who own policies, not Wall Street. This isn't an accident. This is institutional design. And today I'm going to show you exactly why institutions have been quietly using life insurers as their preferred storage facility for over a century, and why understanding this single insight could fundamentally transform your relationship with money. Because here's what the data reveals. If you want to store wealth that feels untouchable, you don't use the institutions that lend money to other people, or worse, lend your own money right back to you at a profit. You use the institutions that are legally required to keep your money safe. Think about it this way. When you put money in a bank, you become a creditor. If that bank fails, you're just another person in line hoping to get paid back. But when you store money with a mutual life insurer, you become an owner, and owners get paid first. This distinction has been the difference between financial survival and financial catastrophe for generations of wealthy families. And it's exactly why every major crisis in American history tells the same story. Banks fail, but life insurers just keep trucking. The question is, why has nobody told you this before? Let me paint a picture for you. Imagine you're a successful business owner with $2 million in liquid assets. You've worked hard for 20 years to build this financial cushion, and you want it safe, accessible, and growing. Your banker tells you about this high-yield savings account paying 0.5%. Your financial advisor suggests a mix of bonds and CDs. Everyone's telling you these things are the safe options. But let me ask you something. Safe compared to what? Now let's run the numbers on what bank safe actually means. The FDIC, the very backstop that guarantees your deposits, how much money do you think it actually has to protect the entire US banking system? Trillions? At least hundreds of billions, right? The real number is $137.1 billion as of December 31st, 2024. That's it, which means for every $100 Americans believe is safe, the FDIC has about $1.20 in actual reserves. Just 1.21%. One serious crisis, and those reserves could be depleted overnight, requiring taxpayer backstops and emergency measures. Now contrast that with the mutual life insurer. New York Life, for example, holds $431.9 billion in assets, with nearly $33.3 billion in surplus at the time of the filming of this video. That's not 1.2% reserves. That's almost 8% excess capital, above and beyond every obligation that they already have. Northwestern Mutual maintains similar ratios with more than $359 billion in assets. These companies don't operate on promises to pay you back someday. They operate on mathematical certainty that they can pay you today. But here's where it gets really interesting. That same $2 million stored with a mutual life insurer doesn't just sit there earning a guaranteed rate. It becomes what I call true liquidity. Money that passes a 4-part test that the bank deposits simply cannot. Test 1. Does it hold its value when markets crash? Your bank account may be FDIC insured, but inflation and currency devaluation can still erode its purchasing power. A life insurance policy's cash value is contractually protected against market losses while participating in the insurer's profitability through dividends. Test 2. Is it tied to stock market fluctuations? Your bank's stability depends on their loan portfolio, interest rate spreads, and market conditions. A mutual life insurer's general account is specifically structured to be countercyclical. When markets crash, they often benefit from flight to quality capital flows. Test 3. Can you access it without tax penalties or major losses? Try withdrawing $500,000 from your 401k or selling stocks in a down market. A policy loan against cash value generates no taxable income and no market timing risk. Test 4. Can you leverage it without interrupting its growth? This is where banks completely fail the test. When you withdraw money from your account, it stops earning. But when you borrow against a life insurance policy, your full cash value continues compounding as if you never touched it. This isn't theoretical. During the 2008 financial crisis, while banks were tightening credit and freezing accounts, policyholders were accessing billions through policy loans at predetermined rates with no credit checks, no application processes, and no interruption to their cash value growth. That's not just safe money. That's institutional grade capital management. The wealthy figured this out decades ago. Walt Disney financed Disneyland with policy loans. Ray Kroc used the same strategy to expand McDonald's. These weren't insurance salesmen, they were business titans who understood that the strongest financial institutions in America weren't banks. They were life insurers, and they all followed the same 3-step pattern. Stack, shield, scale. Let me share something that will fundamentally change how you think about financial institutions. There are 2 types of financial companies in America. Those that must survive and those that can fail. Banks can fail. In fact, they're kind of designed to fail. For decades, they operated on what's called fractional reserves, lending out 90% of deposits and keeping only 10% on hand. Already fragile, right? But here's the part almost nobody realizes. In March 2020, while the entire world was kind of busy and distracted by COVID, the Federal Reserve quietly changed the rules. Legally, banks are no longer required to hold a single cent of your deposits in reserve. While they may hold liquidity for other reasons, the official reserve requirement is now 0. Think about that. Your so-called safe money is sitting in a system that admits it doesn't have enough to cover you and no longer has to keep anything set aside to even try. So here's the ugly truth. Banks aren't just fragile. They're structurally fragile and historically collapse under stress. And yet, for over 150 years, life insurers have operated with the opposite design: stability, certainty, and permanence. They function more like the laws of nature than the guesses of gamblers. And that's not just a metaphor. The way physics works in the natural world is the perfect way to understand how real wealth systems are built. Take Isaac Newton's first law of motion, for example. He taught, and an object at rest will stay at rest unless acted upon by an outside force. Now imagine this in your own life. Picture yourself at the park, pushing your son on a swing. With that single push, the swing carries him forward, back and forth, back and forth. Newton's law is right there in action. Once set in motion, it continues steadily until another force intervenes. And here's why that matters. Your son isn't worried about whether the swing will suddenly stop. He trusts that it will keep moving because you set it in motion. That's exactly how life insurance companies have operated for generations. They were set in motion a long time ago by principles of prudence, discipline, and conservative investment. And because of that, They've continued forward steadily and predictably across centuries. Banks, on the other hand, are more like the kids trying to push themselves without help. They wobble, they lurch, and sometimes they crash altogether. And history shows us every time that swing fails, families get hurt. So the real question becomes this: when the next outside force inevitably hits our financial system, where do you want your children to be sitting? On the swing that's been moving steadily for over 100 years? Or on the one that's unstable, constantly wobbling and waiting to fall? Think of a bank like a restaurant that sells dinner reservations, but only has enough food for 1 out of every 10 customers. As long as most people don't show up at the same time, everything works fine. But the moment too many people want their dinner simultaneously, the system collapses. This is exactly what happened during every banking panic in American history. The Panic of 1837, over 600 banks failed when depositors simultaneously demanded their money. The Panic of 1893, approximately 500 banks collapsed in a single year. The Great Depression, 9,000 bank failures because the system couldn't handle mass withdrawals. But mutual life insurers, they operate on a completely different principle. They don't loan out your money to other people. They stack their capital in a carefully managed general account designed for one purpose: absolute certainty that every obligation can be met. It's like the difference between a restaurant that takes reservations for more seats than it has versus a restaurant that requires payment in advance and guarantees your table will be waiting when you arrive. Here's the data that proves this. During the Great Depression, nearly half of all American banks failed. Life insurers not only survived, they thrived. Industry records show that total assets of all US life insurers exceeded liabilities by $1.4 billion, even at the Depression's worst point in 1932. No policyholder of a major mutual insurer lost their benefits. Meanwhile, millions of bank depositors lost everything, even with the newly created FDIC insurance that was supposedly supposed to protect them. The 2008 financial crisis told the same story. Washington Mutual, the largest bank failure in American history. Indy Mac, seized by regulators. Bear Stearns, Lehman Brothers, gone. But New York Life, Northwestern Mutual, Mass Mutual, Guardian, all maintained their highest credit ratings and continued paying dividends throughout the entire crisis. Why? Because they're structured for permanence, not profit maximization. They understand the war chest principle. Stack your foundation first, shield it from external shocks, then scale through systematic deployment. When you put money in a bank, you're betting they'll manage risk properly, and that the depositors won't panic and that the broader financial system will remain stable. When you store money with a mutual life insurer, you're not betting on anything. You're participating in a system that's mathematically required to work. I mean, here's another way to think about it. Banks make money by being right about the risks they take. Life insurers make money by eliminating risk entirely. Banks profit from the spread between what they pay you and what they charge borrowers. Life insurers profit from the certainty of mortality tables and the predictability of long-term investment returns. One model requires gambling. The other requires mathematics. Guess which one has survived every crisis for 150 years? I know what you're thinking right now. Chris, if this is so obvious, why isn't everyone doing it? Why isn't my financial advisor mentioned this? Why do I have so much of my money sitting in bank accounts earning practically nothing and getting no leverage? Here's the uncomfortable truth. You're not the problem. The system is. You've been conditioned to think like a retail consumer in a game designed for institutional players. You've been taught to chase yields and compare interest rates when the real game is about structural safety and capital velocity. But the ultra wealthy aren't playing the same game as retail investors. They're not chasing the highest yields or the hottest investment trends. They're building systems that compound wealth regardless of market conditions. That's exactly why I created the war chest principle. I'm Christopher Hemmert, and I founded this system after working with high-income entrepreneurs who were doing all the right things, yet still felt financially vulnerable. What I realized was they didn't need more performance. They needed a system designed to last. I've spent the better part of a decade studying institutional capital management. Not the flashy hedge funds or the investment banks, but the boring, methodical institutions that have survived everything history could throw at them. Mutual life insurance companies, endowments, family offices, and sovereign funds that have all preserved wealth across multiple generations. And what I discovered is that there's a massive gap between what institutions do with their money and what individuals are taught to do with theirs. Institutions think in terms of permanence. Individuals are taught to think in terms of performance. Institutions prioritize what I call the stack, shield, scale sequence. Individuals are taught to scatter their money across multiple accounts and hope for the best. Institutions use life insurance as a core holding. Individuals are taught to view it as an expense. The war chest principle exists to bridge that gap, to help people like you access institutional grade strategies without institutional grade complexity. The system isn't something I invented. It's something I observed, documented, and turned into a repeatable framework. 3 steps: stack, shield, scale. 1 objective: transform earned income into a self-funding wealth engine that works whether markets go up, down, or sideways. Stack your foundation in a vehicle that cannot lose value and provides guaranteed growth. Shield that foundation by borrowing against it instead of depleting it, so your capital base continues compounding while you deploy that same money elsewhere. Scale by reinvesting all cash flow, tax savings, and investment profits back into the system, creating velocity that accelerates wealth creation without requiring additional earned income. You already have what it takes. You just need to understand the rules of the game that institutions have been playing all along. Now, you might be thinking, this sounds like it requires millions of bucks and a team of specialists to implement. But here's the beautiful thing about institutional principles: they scale. The same mathematical concepts that protect billions in institutional portfolios can protect thousands in personal portfolios. Let me walk you through exactly how the war chest principle works in practice, using the 3-step system that mirrors institutional capital management. Step 1, stack. Fund your war chest. This is where most people get it backwards. Instead of keeping money scattered across multiple bank accounts earning practically nothing, you consolidate it into a single vehicle that meets institutional standards for true liquidity. The war chest principle teaches you to stack your capital in a dividend-paying, cash value life insurance policy issued by a mutual company, structured for maximum cash value growth. Why this vehicle? Because it's the only financial instrument available to individuals that replicates the balance sheet characteristics of the institutions themselves. Your cash value grows at a contractually guaranteed rate, and historically, mutual companies have delivered 4 to 6% annually when dividends are included. But unlike a bank CD that locks up your money, you maintain complete liquidity through policy loans that don't interrupt the growth. Think of it like this. Imagine if your bank account kept earning interest even after you withdrew the money from it. That's exactly how the stack phase of the war chest principle works. You can borrow against it for any purpose while your full balance continues compounding as if untouched. This is precisely what institutions do when they stack their reserves. They don't chase yield. They prioritize certainty, access, and the ability to leverage without interruption to their growth. Step 2, shield. Deploy capital without depleting reserves. Here's where the war chest principle gets really interesting. Instead of withdrawing money from your stack to make investments, which would stop the compounding growth, by the way, you shield your principal by borrowing against it. Let's say you've stacked $500,000 in cash value. Traditional thinking says you need to choose: keep it safe and earning modest returns, or risk it in higher return investments. The war chest principle says, why choose? You shield your $500,000 by borrowing, say, $400,000 against your cash value at a fixed rate, typically 5 to 6% annually, and deploy that capital into productive income-producing assets, like rental real estate or private lending opportunities. Now you have $500,000 continuing to compound in your policy, plus The 400,000 working in the productive income producing investments. $1 doing 2 jobs. This is the essence of the shield strategy. Protecting your foundation while expanding your deployment capacity. The income from those investments can service the policy loan payments while often generating additional cash flow. Your original stack never stops growing, and you've significantly expanded your deployment capacity through intelligent shielding. This mirrors exactly what institutional balance sheets do. They maintain their reserves while leveraging them for productive purposes. Step 3, scale. Reinvest everything back into the system. This is where velocity creates wealth multiplication through the war chest principles scale phase. The cash flow from your income producing assets plus any tax benefits gets channeled back into either paying down policy loans, which restores your borrowing capacity, or acquiring additional income producing assets. So let's run the numbers in simple terms. Suppose you've built $500,000 in your war chest. Instead of withdrawing it and breaking compounding, you borrow $400,000 at a fixed rate, say 5% cost. That's about $20,000 in annual interest. You then place that $400,000 into an income producing asset that generates a 6% rate of return, around $24,000 per year. On the surface, that looks like a $4,000 gain. And some people might say, why take the risk for such a small spread? But here's the key insight. Your original $500,000 is still compounding uninterrupted at 4 to 6% inside the policy. That's another $20,000 to $30,000 in guaranteed growth happening in parallel. $1 doing 2 jobs. That's not about chasing yield, man. It's about building a system where your foundation keeps growing while your deployed capital works too. And as you recycle the cash flow through the scale phase, that thin spread multiplies into meaningful velocity over time. The result? You transition from working for money to having a system that generates money autonomously through the stack, scale, shield sequence. But here's the critical insight. This isn't about life insurance as an investment. It's about accessing the institutional grade balance sheet management that mutual life insurers use to protect their own capital through the same stack, shield, scale methodology. When New York Life or Northwestern Mutual manages their general accounts, they're using the war chest principle at institutional scale. They stack reserves, shield them through careful leverage, and scale through systematic reinvestment. The difference is, instead of being an outside investor hoping their strategy works, you become a direct participant in their mathematical certainty by implementing the war chest principle personally. And it's exactly why institutions structured around the war chest principle, like mutual life insurers, have consistently weathered crises that caused many banks to fail. The mathematical difference is profound. If you consistently stack earned income into a compounding system and live off the cash flow it produces when you shield and scale, your wealth becomes resilient. Market crashes have far less impact because your system isn't tied to market performance. Economic recessions are less damaging because your cash flow is backed by contracts and not speculation. Even career setbacks don't disrupt the system because it keeps operating independently of your labor. This is institutional thinking applied to personal wealth management through the war chest principle. Because here's what the data reveals. In wealth building, boring wins. Complexity fails. And institutions that have survived 150 years of crises have something to teach us about building systems that last. Through the war chest principle. But this isn't about what you do with your money. It's about who you're becoming in the process. If you're still thinking like a consumer, chasing returns, stock tips, and advice from people who profit from your confusion, you're playing the wrong game. But if you're ready to become part of the new class of wealth architects, people who engineer financial systems with institutional precision, then you're exactly who we built this movement for. Before I show you where to get the complete system, let me share one more insight with you that most people never discover. The wealthy don't just think differently about where to store money. They think differently about what money is for through the war chest principle mindset. Most people view earned income as money to spend and passive income as money to save. The war chest principle teaches the exact opposite. Earned income is capital to stack, and passive income is money to spend. This reversal changes everything. When you earn $100,000, instead of spending it, you stack it. When your war chest grows large enough to shield into assets, the income those assets produce becomes your lifestyle money, while your capital keeps compounding. This is why wealthy families can maintain their lifestyles indefinitely. They're not spending their capital. They're spending the income their capital produces through the stack, shield, scale sequence. It's the difference between eating the golden goose and eating the golden eggs. And it's exactly why institutions structured around the war chest principle, like mutual life insurers, have consistently weathered crises that caused many banks to fail. The mathematical difference is profound. If you consistently stack earned income into a compounding system and live off the cash flow it produces when you shield and scale, your wealth becomes resilient. Market crashes have far less impact because your system isn't tied to market performance. Economic recessions are less damaging because your cash flow is backed by contracts, not the speculation. Even career setbacks don't disrupt the system because it keeps operating independently of your labor. This is institutional thinking applied to personal wealth management through the war chest principle. Because here's what the data reveals. In wealth building, boring wins, complexity fails, and institutions that have survived 100 years of crises have something to teach us about building systems that last through the war chest principle. But this isn't just about what you do with your money. It's about who you're becoming in the process. If you're still thinking like a consumer, chasing returns, stock tips, and advice from people who profit from your confusion, you're playing the wrong game. But if you're ready to become part of the new class of wealth architects, people who engineer financial systems with institutional precision, then you're exactly who we built this movement for. The war chest principle isn't just a strategy, it's a shift in identity, man. From consumer to controller, from speculator to system builder, from hopeful to certain. And it's exactly what you'll discover in the complete war chest framework at warchestprinciple.com. There's a free resource there that walks through the specific mechanics of how wealthy families structure their capital using the stack, shield, scale sequence, including the 4-part test for true liquidity that most financial advisors have never heard of. You'll also see why the boring approach to wealth building, the one that prioritizes preservation before multiplication through systematic stacking, shielding, and scaling, often outperforms the exciting approaches by massive margins over time. Let me leave you with 3 insights that change everything about how you think about money. First, the safest place for your money isn't the place that promises the highest returns. It's the place with the longest track record of never losing capital. Banks have failed by the thousands. Mutual life insurers have survived virtually every crisis in American history by following the war chest principle at institutional scale. Second, true liquidity isn't about access to your money. It's about access to your money while it continues working for you. The ability to shield your capital base while deploying it productively is the foundation of the war chest principle and institutional wealth management. Third, the wealthy don't choose between safety and growth. They structure systems that provide both simultaneously through stack, shield, scale methodology. $1 compounding safely, while the same dollar works productively in income-producing assets. These aren't advanced financial concepts. They're institutional basics that individuals are just rarely taught, but they form the core of the war chest principle. The question isn't whether these strategies work. 150 years of data proves they work. The question is whether you're ready to think like an institution instead of a consumer by implementing stack, shield, scale in your own financial life. Your money doesn't have to be subject to market volatility, banking instability, or economic uncertainty. It can be structured with the same mathematical precision that has protected institutional capital through wars, depressions, and every financial crisis in modern history, all through the systematic application of the war chest principle. The institutions have been showing us the way for over a century, They've proven that wealth preservation and wealth multiplication aren't opposing strategies. They're sequential steps in the same system. Stack your foundation. Shield it through intelligent leverage. Scale through systematic reinvestment. Look, you've earned your income through skill, effort, and intelligence. Now it's time to earn your freedom by deploying that income with institutional precision through the war chest principle. The choice is simple. Keep playing by the retail rules and hoping for the best. Or start playing by institutional rules and building for certainty through the stack, shield, scale methodology. The war chest principle gives you the institutional playbook. The only question is, are you ready to use it? Visit warchestprinciple.com and go view the free private briefing that I prepared just for you and discover why the most boring financial strategy might be the most revolutionary approach to building lasting wealth. Because sometimes the most powerful insights are hiding in plain sight. You just need to know where to look, and you need to understand how to stack, shield, and scale like the institutions that never fail. Well, ladies and gentlemen, I hope that this message blesses you. I hope that the data blesses you. Take great care, and I will see you at the next one. Until then, God bless. Bye for now.